I'm joined live from Zurich by Christian Gattiker. He's head of research and strategy at Bank Julius Baer Co. Thanks so much for your time. So, should investors be favouring stocks over bonds right now? Where do you stand on this?
Well, I think this the model you just presented, is giving you more like a strategic asset allocation. I think for the time being, given the seasonal issues we have, given the bond supply that's coming up in September from governments in Europe in particular, I think on a tactical basis there's no rush, there's no hurry to go into stocks. I think there are some flaws to these Fed version models. I mean, it's based on Greenspan's Fed model, and I think you have to be very careful with these things. I think into 2011 maybe we'll get at some stage a better buying signal, and that will also be supported by the model you just presented.
Yeah, so you're somewhat skeptical perhaps of the Fed model that compares corporate earnings with interest rates, but does it accurately reflect what's been happening in bond and equity markets recently in both the US and Europe? Because we have of course seen an aversion to risk over the past few months with more money flowing from stocks into bonds. Are we about to see a turnaround, do you think?
Well, I think an intermediate turnaround is well in the cards. I think sometime between October and the first quarter of next year. But for me, that's rather tactical. I think this model didn't really work in deflationary mode. So meaning for Japan, for instance, you got a lot of wrong signals because earnings didn't ever live up to the expectations of the bond market, and therefore you suddenly hit a wall with these type of models. And I think it's worthwhile looking at the whole deflationary threat before being too confident about this model. But of course, in shorter periods, and this model has like a 3 to 5 year prediction track record, I think in shorter term periods there might be some extremes that might be helpful. But if you look at March 2009, I mean, you had to go very, very far down. If you just started buying at -1, you accumulated losses over 3, 4, 5 months.
So what are you saying? Is it a good idea to use your fixed income money to buy equities instead? What should investors be doing in the current environment? How should they position their portfolios with the deflationary threat in mind?
I think for the time being, there's a case for holding some cash to keep some powder dry. I think you may remain invested in the bonds. I don't expect that will exactly are at the peak of the bond bubble. I think we have signs of a bond bubble building. I think yields on a 5 to 10 year basis are probably too low, but I think there's more to come. There's so much flow into these issues. I think the baby boomer generation is simply after being hurt twice with equities and having a shorter investment time horizon, they're simply buying bond like there's no tomorrows, and therefore yields may stay low for the next 2 to 3 years. I think from that perspective, it's rather a tactical call again. And at this stage, I would keep some powder dry. I would remain conservative. I would wait for the bond issues that are coming up in September, and then reassessing the situation.
So keep your powder dry, a wait-and-see approach. Christian, thanks very much. Christian Gattiker there, I should say, head of research at Bank Julius Baer.